What's up, guys? This is Vael. Today we're going to be doing a bit of a rants series where I talk about my risk reward strategy that I use to identify my risk reward in every single trade. So going over the practical application of how I apply risk reward in terms of per trade basis. And I will be talking about this in reference to a small cap momentum trading strategy, which is Ross Cameron's trading strategy, where we trade small caps with low float, prices between $1 and $20, up more than 10% on the day in terms of the percentage gain on the day, greater than 5 relative volume, and has a catalyst such as news. So I have a VOD pulled up here, so I'm just going to quickly go over how I think about risk reward in the middle of a trade and how this could benefit you in your trading. Of course, I have to make the disclaimer that I've only been trading for 9 months, and I'm still a student of warrior trading, and some of these strategies may evolve over time. However, in my trading right now, I've had a 1.5 profit to loss ratio pretty consistently over the past couple of months, even with a couple of big losers factored in. Taking out those bigger losers, I have about a 2-to-1 profit to loss ratio. And the bigger losers were mainly from some of the position sizing mistakes that I have made previously. And I ended up fixing those. We will talk about that, but let's first get into what I do in the middle of each trade to think about risk reward and what I do here. So let's play the video. So here is a trade from just a couple of days ago, Monday on the 18th, which is May 18th at 8:17 a.m. I traded LABT. So right here, we have a bull flag pattern from a continuation on breaking news. I'm looking at this stock as it's consolidating right under 350 with a bull flag pattern. So I'm thinking here that as this closes in 5 seconds, I can get in for the break of 350, expecting it to squeeze up. So you'll hear me say on stream here that as I enter at 349 here, that my target is 75 and my stop is 45. So here I take a little bit of profit. I sell half up at 66. I think I intended to take profit at 75, but I just got filled a little bit lower. And I held the rest up to $4 to see if it had the opportunity to break through. Now you can see it pops up to 390 and it kind of stalls out a little bit. So I wait to see if it breaks through, but as it doesn't, I sell the rest there for a small winner. I think that was a $27 winner. I don't have the P&L on the screen, but it ends up being a pretty nice trade. And the key things I want to highlight about this trade is saying my stops and my profit targets out loud before every single trade. So as I'm getting into this trade, I am thinking about what my profit target might be, and then I adjust my stop according to my average price, what average price I get in. So right here, we have a $3 stock with a 9 million share float. So what I'm thinking about is I'm thinking where does this have the potential to move to? Where's the next level of resistance and how much could it go up? It has quite a bit of volume. We're at like 1.5 million shares of volume in the last couple of green candles. And I'm thinking conservatively that this stock might move up to 75. If it breaks through 75, then it could go up to $4. But I set my first profit target at 75 in case it rejects and comes back down. I'm thinking a $3 stock being a bit of a lower price, not quite as low as $2 or $1, but generally I would expect a $3 stock to move maybe 20 to 25 cents. So I'm thinking about my entry for the break of 350, for the move of 25 cents up to 375. That's my target. Okay, what's my stop? If I get in at 350, then my stop is 345, being a 5-cent stop. If you factor in slippage, if I get out with a stop of 345, then my stop would be about 10 cents, or maybe a little bit more than 10 cents if I'm unlucky and I get out at capitulation. This gives me a greater than a 2-to-1 risk reward ratio because I'm risking 10 cents, my stop being 345, with a profit target of 375. But that's not all. If it breaks 375, then my profit target could be even more than that. It could be 50 cents, in which case I would have a 10-to-1 profit to loss ratio, right? So I'm only risking 5 cents, or we could say maybe at, a 5-to-1 if you factor in slippage, which is a very good profit to loss ratio. And part of the reason why I can expect these moves is because we're breaking out on a stock that has the attention of a lot of traders. You can see LABT on the scanners up here is our third top leading gainer, even though it has a bit of a higher float at 9 million shares, where I would normally, in this kind of cold market that we've been having lately, I would like to trade less than 5 million share floats. But since we're up 122% of the day and we have quite a bit of volume, we can still expect it to make a bit of a bigger move than it normally would. So I'm thinking right here, my risk reward is very good. I can get in at the $0.50. I know where my stop is, and I know what my profit targets are. And I encourage everyone to try out this strategy and see if it works for you. It certainly works for me. Thinking about my profit targets and my stops before I get into the trade, before emotional hijack takes over and tries to get me to lower my stops. I've already said it out loud, so it's set in stone, especially when I say it out loud to the stream, to people who are listening to me. They know my stop is 345. I know my stop is 345 because that's what I set it as I entered the trade. So if I move my stop down, then I would be breaking my rules that I set for myself. I think it's a good habit to have to kind of take into account what your profit targets and what your risks are. And the key thing here is that your stop should, if you want a 2-to-1 profit loss ratio, then you need to make sure that your stop is half of what your profit target is. So if my profit target is 10 cents, then my stop should be 5 cents. If your profit target is 50 cents, then your stop should be 25 cents. But you should also factor in slippage as well. So let's say 50 cents, your stop is maybe 10 cents, because after you factor in slippage, if you get out as the stock is dropping, then you might get out at maybe 5 or 10 cents lower than you actually intend to. Let me share another example here of a trade that I took recently. This trade was on May 22nd from one of my live streams. So the first example showed a successful trade where I sold half into strength at my first profit target at 75, although it's sold a little bit lower than I intended, and sold the remainder up as the stock was stalling out. Now, this is called a 1 entry 2 exit strategy. And most of the VODs I'm showing are, because I'm still early on in my journey, are going to be more of a beginner scaling strategy with either 1 entry 1 exit, 1 entry 2 exits, or at most 2 entry 2 exits. I'm still pretty early on in my journey, so scaling in and out dynamically is going to be a little bit more challenging. And that's something that I'm going to have to work on as I continue through my journey. But that was a 1 entry 2 exit strategy. On this example that I'm showing here, this is going to be a trade where I ended up getting stopped out. And I'll highlight this example to show my exact thought process as I'm stopping out of the trade. So on this particular pattern, you can see in the video, we had a previous ABCD pattern here earlier on that I had success with. I made a little bit of money on it, and it popped up to 450, 472, and then pulled back. And here we see another ABCD pattern forming. So as I'm as this pattern is forming here, we got 22 seconds left on this 1 minute candle. I'm thinking, okay, well, this might form another ABCD pattern for the breakthrough 450 and a retest of the high of day, which was 472. Now, I was a little bit more cautious about this trade because MACD was very close to crossing over. We have decreasing volume on the 1 minute, and the last candle that went up to test 472, which is the 475 $0.25 level, had a pretty high volume rejection. So on this trade, I only enter with quarter size, 50 shares instead of 100 shares as I did before. Let's play the VOD and I'll tell you what my thought process during this trade was, being a little bit more cautious of the trade. So 22 seconds are left on this 1 minute candle. So I'm thinking if it breaks 450 here, then maybe we could see a squeeze up to retest high of day. So 10 seconds are left on the candle. My eyes are on the ask on the level 2, waiting for a surge in volume. And right there, I say I'm taking a position, looking for a break of 450. It breaks 450, but as soon as it drops back down there, I'm back out of the trade. And that's what I call a breakout or bailout mentality. Now on stream this time, I didn't exactly communicate my profit target and my stops. Instead I said specifically, I'm looking for a break of 450. And when I say that, usually I mean that I'm looking for a break in an immediate resolution. And my target is always going to be the next nearby level of resistance, which is high of day here. First of all, if it immediately breaks through high of day, then maybe the next level of resistance would be $5. But here I was looking for a break of that 450 $half whole dollar level of resistance and immediate resolution to squeeze back up and retest high of day. Since it didn't do that, I'm immediately back out of the trade. As soon as it breaks back down 450, I'm back out of the trade. Right here, you could say that my eye was pinned to the ask. We'll watch it again. My eye was pinned to the ask price, looking for the breakthrough 450. We see it breaks 450 for a second and then it drops back down. And I said, that's a false breakout. I'm back out. In most of these trades that are happening, my eye is pinned to the ask to see if the ask price hits or passes my stop. And here, because my entry was 450, around 450, my buy was 447 and I was looking for 450 to break. My stop was a breakdown of support. And every time it breaks down support, it usually goes down like 5 or 10 cents because, you know, other traders are also stopping out, right? They see that that's a false breakout and they immediately hit the bid. So I do the same. I hit the bid, I get out, and as the trade resolves, I know that MACD is now going to cross over. Now we have a false breakout here, and the stock started selling off. So, you know, having this sort of breakout or bailout mentality on when you're getting into trades keeps you from unnecessarily increasing your losses, you know, the risk side of the risk reward ratio, and keeps your stops tight. So here, you know, I said I'm looking for a break of 450. I could have said instead, I'm looking for a retest of high of day, 475, with a stop of 445. That would be the same thing, right? Because as soon as we broke back down 450, we ended up at a price below 445. So you see it breaks over 450 here, and then it drops down to 440 immediately. So that would be a signal to immediately get out. You're stopped out, right? They're both the same. It's just that, you know, the whole dollar level of resistance might say it a little bit differently sometimes, but the intention is the same, right? That breakout or bailout. So I wanted to show this here as well. This is a calculator sheet that I made for myself, which generally gives me some guidelines about the profit targets and stops that I should be using for each individual price. Because as I said before, the amount of cents per share that you can expect the stock to reasonably move depends both on its float and its price. So as you get into a trade, you can kind of get a feel for how the stock is moving and what the price of the stock is to determine what your profit targets might be. And then you can determine your stop based on those profit targets. So generally speaking, from $4 up to $9, I would say, okay, most of the time for a stock that has, a catalyst, it meets all the criteria of stock selection and it's breaking out, I can expect this to move up to the next half dollar or whole dollar. So you get in at 5, factoring a little bit of slippage, you can expect it to go up to 5.50, right? So your target is 40 cents, in which case your maximum stop should be 20 cents. For this price range, like I said, factoring in slippage, I would generally try to exit earlier than 20 cents. So I would exit maybe with a 5 or a 10-cent stop. But you get the idea. Like, that's the price range. These are the guidelines. For a $2 to $3 stock, they tend to be a little bit grindier. They don't move as much. So my target on them is about 20 cents. I'd set my stop to be about 5 cents. For a $1 stock, it's even more, right? I only expect them to move maybe about 10 cents before it slows down, in which case my stop is 5 cents. And for 10 and above dollar stocks, these tend to move at rates of dollars per share, in which case my stop is 50 cents. Maybe I try to get out at 25 cents to factor in slippage. I also wanted to clarify that one of the really good practices that I've implemented into my own trading, if you're not used to getting out early, if the trade isn't working out, is maybe you just set a 5 or 10 cent arbitrary stop on every single one of your trades for a little while if you're a beginner, to kind of get that habit of a breakout or bailout mentality, because the best trades that work tend to work right away with this strategy, right? The trade immediately goes in your favor as soon as you get in. And you even saw in that VOD there earlier, I got in and the stock immediately spiked up to 375 and then continued going higher to $4. The best trades tend to work out like that. If your entries are right and your stock selection is right and the stock has a lot of volume, getting a lot of attention, it's a proper pullback, most of the time your trades are going to work out really quickly. You're going to get in and it's going to spike up immediately if your entry is right. And in this case, you can set your stop really low. Like, you can set it 5 cents or 10 cents below your entry point, because most of the time, if your entry is correct, price isn't going to come down to retest that point. If you're entering in with level 2 and there's a lot of green on the tape and price is moving up quickly, it's probably not going to come down and force you to stop out. Most of the time. Sometimes it will. Most of the time it won't if your entries are all good. So it's a pretty good practice that I've found to set a 5 cent or 10 cent stop when you get in, and focus on getting in at the right time. And if you're stopped out, then you're not getting in at the right time. I think that's a pretty good practice to have early to get that habit of breakout or bailout mentality, setting a 5 or 10 cent stop, especially because, if the trade is not immediately working out in your favor and you wait too long and you get out a capitulation, then that's where slippage can really start to become a problem and eat away at your profit loss ratio. Whereas if you get out early as it's stalling out, maybe don't take your winners too soon if it turns into a winner. But if it goes up 5 or 10 cents and you weren't expecting it to only go up 5 or 10 cents, say you set your profit target at 50 cents, right? It only goes up 15 cents from your entry. And you're like, well, wait a minute. I thought this would move a lot quicker. But there's a lot of upside resistance. You see a big seller, you see some sort of exit indicator. Maybe it has a topping tail. Maybe it does go up to 50, but then it pulls back 25 cents. At that point, you can exit a bit early, just in case there is a risk that it turns around and ends up rejecting pretty hard. So best practices are hold your winners until you see an exit indicator, you see some sort of risk that price isn't performing as you expected it to, and that breakout or bailout mentality where you set early on, you set a 5 or 10 cent stop. But as you gain more experience, and as I've been gaining more experience, I can kind of dynamically set my stops according to the trade that I'm taking and my average cost basis and where nearby support and resistance are, and kind of play it like that. But breakout or bailout mentality is a pretty good mentality to have, in my opinion. And these position sizes are calculated based on the risk that I'm comfortable taking with my account currently. So I said that the risk that I am comfortable with is 2% of my account size, from $1 to $9. And because I don't tend to do as well in higher price stocks and there's more slippage involved usually because they're moving quicker with bigger ranges, I risk 1% of my account size, my $2,000 account size on these higher price stocks. So with these things in mind, whenever we take a look at a stock that we want to trade, we can very quickly calculate our profit targets and our risk reward and how much we expect the stock to move. So we'll take a couple examples here from after hours. I just opened up the chart here. So HCWB made a nice big move earlier up to $4. I'll fix the date range so that we can go back and look here. So let's take an example from HCWB at regular hours. 1 minute has a bit of a flat top break here at 255, right? So the 1 minute and the 2 minute, they kind of formed a bit of an ABCD pattern here, bouncing off of the 9 EMA. So right here, I might have been looking at the ABCD pattern, and as we're forming a bit of a cup and handle on the 10-second here for the breakthrough 255. So if I were to get into this position for the break of 250 here on this cup and handle pattern, maybe I buy at 251 expecting a break, in which case for a $2 stock, as I've said, my profit target on these are about 20 cents, in which case my stop would be 10 cents, but factoring in slippage, my stop would actually be 5 cents. Right here, I would get in for the break of 250. I would say my stop is 245, or whatever my average price is, minus 5 cents. And where would my profit target be? So profit target would be 20 cents, 20 to 25 cents, usually at the next level of resistance, which would be the next $0.25, which would be 275. As you can see here, it popped up, bounced off of 275. I would probably take profit as it's bouncing off of 275 and holding the remainder to see if it can break through and continue the move. I might sell as it comes up to 3 and it stalls out there. So this sort of plan very clearly tells me what my risk reward ratio is as I'm getting into the trade, because I can calculate it based on the price of the stock and based off the levels of resistance and support, being the $0.50 whole dollar. Get in at 250, stop is 5 cents below. Profit target is 75. So we have a more than a 2-to-1 profit loss ratio factoring in slippage. And we don't cap our winners, so we let them run as long as possible. It goes up to $3. So we have a positive risk reward ratio on this. And if it ends up failing, say we get in at 250 and it rejects, drops back down below 250, breakout or bailout mentality, we get out 5 cents below very quickly. so that we're not getting out at capitulation. We don't lose more on our risk reward. Let's look at another example. Maybe a bit of a higher price stock here. Let's see, regular hours, $7 stock, MWC. I think I talked about this a little bit earlier on stream. So back here during pre-market, I was talking about how this was a higher float, a bit of a higher price. So I was looking at MWC here for the break of VWAP, the reclaim of VWAP there as it was curling back up. I didn't take a trade on this because it's outside of my float range that I normally trade. You know, it was a 20 million share float, a bit higher priced. I couldn't really tell you what the news catalyst was. I didn't take a trade, but if I did take a trade, I would calculate my risk reward like this. It reclaimed VWAP. You can see here it has a bit of a flat top around 1150. We said before that a higher price stock above $10, we would normally expect it to move about $1 per share because higher price stocks tend to move a bit faster than lower price ones below $10. So I would normally say that my target for the break of 1150 would be 1250 with a stop of maybe 1125, factoring in 25 cents of slippage to give me my 2-to-1 profit to loss ratio. However, this stock has a higher float, 20 million shares. So this might move 2 or 3 times slower, right, than a stock with less than 10 million share float. So we would have to cut that expected profit in half. So in this case, I would say that my profit target would be $12. Even though this did move up to 13, we can't guarantee that. My first profit target might be $12 being the next whole dollar with a stop of maybe about 15 or 20 cents. So maybe I would say that my stop would be a breakdown of VWAP. If I got in maybe at 1125 expecting the break here, but if I got in at 1150, my stop would probably be more than likely a breakdown of 1150. Since they move quickly, it would probably be like 1130 or so, 1135. But I would probably get out immediately for the breakdown of support, expecting there to be a bit of capitulation, maybe 15, 20 cents of slippage. But if I were to get into this trade and say my stops out loud, I would say I'd probably get in at 1155. I would say my stop is 1145 for breakdown of support. My target would be 12. So by saying these things out loud, I cement them in stone before emotional activation kicks in, and I want to end up moving those stops. Now I have them to fall back on since I've said them out loud, and I can keep that in the back of my mind. Stop of 1145, target of 12, first target of 12. We don't take profit too soon, and we don't cut our losers too late. We don't hold and hope. We don't jump at the profits as they come out at us. We hold until we reach our first profit target, unless it stalls out and it shows signs of rejecting or signs of reversing, and we might want to scale out. But if we can, we want to hold to those profit targets to maintain that 2-to-1 ratio. Another thing that I want to touch on is the psychology of rules and risk. So because we're traders, losses and drawdowns are inevitable, right? I think everybody agrees with that for the most part. Anyone who really understands trading has probably spent their time in the past searching for the holy grail, searching for the indicators or the strategy or whatever that is going to be right 100% of the time. You never have to deal with losses. You're making tons of money. You're making bags of money. But nobody ever finds that strategy because nobody has perfect information. Traders operate on a set of probabilities that setups are going to work. And you're looking for an edge in the market which gives you positive expected value based on those probabilities, based on your accuracy, based on your profit loss ratio. But because we don't have all the information, sometimes even if you follow your rules and do everything right, you can still lose on the trade anyways. And not only that, you can go on extended losing streaks, even if you followed your rules perfectly. And through no fault of your own, you could end up with a 10%, a 20%, a 30% drawdown, depending on your accuracy and your profit loss ratio, through no fault of your own. Because every time you enter a trade, there's always the possibility that there's someone in a big hedge fund bank with their hand on the sell button, ready to just dump their shares as soon as you enter a trade. And you would not have that information, but it's always possible, right? And you're competing against algorithms in a lot of these trades. You know, through no fault of your own, you could enter a trade and suddenly the bids just fall out from underneath you and the stock tanks and you have no idea why. The stock looks good, everything looks good, you followed your rules, but it doesn't matter. However, over a long period of time, if your strategy is profitable and you execute on it consistently, you will make money. You will enter drawdowns, but you will come back from those drawdowns and you will make money. So where do you draw the line between a good trade and a bad trade? What is a bad trade? Is it a loss? No, because you can still lose and it could have been a good trade. Probabilistically, if you enter that trade and you perform everything right, you followed all your rules, and you normally make money on it, but this time you didn't. You can say, I did everything right. This trade would normally make money. It just didn't this time. But the next 7 or 6 times you execute that same trade, it's going to make you money. So it doesn't matter if that one trade lost you money because it was a good trade, because you followed your strategy, you followed your rules, and you know that over a long period of time, in all probabilities, you will make money on that trade. So those are winning trades. Winning trades can be winning trades even if they're a losing trade, if you understand what I mean. So what is a losing trade? An actual losing trade. In my opinion, a losing trade is one where you don't follow your rules, you don't follow your stops and your profit targets, you don't execute on the trade properly, and you let emotions take over. Those are losing trades. When you lose not because of market probabilities, but because of your own actions. Because you did something that was outside of your strategy and is not consistently profitable over the long term. What are some examples of this? Holding and hoping. Holding and hoping absolutely destroys your profit loss ratio. Let's use this chart as an example, right? If I get in at 1150 and I'm confident that this stock is going to go up, I'm like, this is going to go up. This is going to go all the way back up to $27. It's not realistic to expect that, right? This is a dead cat bounce. We're on the bottom side of the move. We see it's just kind of gone sideways all day after reclaiming VWAP and failing to go higher. But there's some people out there that are like, this is going to go back all the way up to $27. We're at all-time skies. We're blue sky setup, yada yada. But nobody can see the future, right? That's not a realistic profit target to set. But like, let's take this trade as an example of where my max pain would be. Like, if you held and hoped onto this, got in at 1150, and maybe your max pain is, I don't know, maybe it's like down, maybe it's down here, right? The low of the pullback, 669. So you're holding for $5 a share. Maybe that's your max pain. All right. What's your max reasonable profit target on this? reasonably, maybe VWAP, because VWAP has just shown to be a significant level of resistance. If it pops up to 1150 and fails to break through VWAP, VWAP is now a significant level of resistance. So if you were to enter down here at 669, as it pulls all the way back on a fresh entry, your first profit target, I would not set my first profit target to be all the way up at VWAP if I entered down here. It would probably be closer to like the 200 EMA or maybe one of these pivots or something. But let's say you held all the way up to VWAP. Just to break even, you would have a negative profit to loss ratio, right? You would be risking $5 per share, make nothing. Let's say you were confident that it was going to go up to it's going to go up to like $13 or $14. You're still risking $5 a share to make like $3 a share. That's still a like a 0.5 to 1 profit to loss ratio, or maybe a 0.25 to 1 profit to loss ratio. You would need a very, very high accuracy just to break even on those. And as a beginner trader or as a trader who is learning, can you maintain that high of an accuracy? Most probably not. Probably what's going to happen is you're going to take profits too soon as it comes back up, because you're going to be emotionally hijacked from letting it fall down $5. Falls down $5, and as soon as it comes back up to 1150, breaks 1150, you're going to take profit. 1175, $12. Oh, thank God it just came back up. Thank God I held, because I would have been down. I would have been down so much. But over the long term, if it never comes back up, it's going to destroy your profit loss ratio and your profitability, because that is a negative profit loss ratio. You're risking $5 to make nothing. You're risking $5 to make 25 cents, 50 cents. So even if it curls back up maybe 1 out of every 3 times, it's still going to be hurting you in the long run. You're still going to be losing money. For example, if I trade 100 shares, if I trade 100 shares on this, my risk is $500, but I'm making $50. 50 cents for $5. That type of profit loss ratio where you're getting out at max pain. How many times would I need to win to make up that $500? What would my accuracy need to be? I would need to win 10 times in a row to make up that $50, right? I would need above a 90% accuracy just to be break even. That is not sustainable, not consistent in the long term. That is why I believe it's so important when you enter your trades, before you become emotionally hijacked, you should know what the levels of resistance are, what your profit targets are, and also importantly, what your stops are. And if each of those profit targets and stops are a good profit loss ratio that is good for your strategy. And I don't see a lot of people do that. There's quite a few people that I've watched that will hold and hope, and then they hold as it goes down and down and down. And I'm thinking to myself as I'm watching them, all right, so now you're at a 0.5 profit to loss ratio. Okay, 0.3 profit to loss ratio, 0.2 profit to loss ratio. And when it comes back up and they get a small winner, they're like, oh, I knew that was going to come back up. That was a good trade. I'm thinking it was not a good trade. Not a good trade. But that's a little bit of the Dunning-Kruger effect there, because a lot of people tend to exaggerate their performance in their winning trades. They don't understand that a winning trade is technically not a winning trade if you don't follow your rules and you don't have risk reward parameters and profit loss ratio for every single trade. They only categorize in winners and losers, and they look at their statistics and they go, I have a 70% accuracy and 80% accuracy. My strategy works. And unfortunately speaking, if you're losing money, there's a reason why you're losing money, and that's because your profit loss ratio is not enough to be consistently profitable, even with that accuracy, right? As I said, you can have an 80% accuracy but still be losing money. And accuracy and the amount of money that you're risking per trade also has an inverse relationship. So the more money that you risk, the lower you set your stop, the higher accuracy you will have, because you're giving the trade more room to work. And your entries don't need to be as precise. As someone who has a 5-cent stop, they need to be very precise with their entries. But if your stop is 30, 40, 50 cents, your accuracy is naturally going to be higher because you're not getting stopped out as much and being forced to take the loss. Also, on the other side, if you're taking profits too soon, your accuracy also increases because you're not having to wait as long to book the win for the stock to go up. It doesn't turn around as much on you if it moves up 3 cents and you book the profit before it rejects. So your risk reward and your accuracy are tied to your profit targets and your stops. And you can be under a bit of an illusion that your strategy is working depending on how you execute it if your accuracy is high. But you need both your accuracy and your profit loss ratio to both be high consistently to be profitable. 50-50 accuracy with a 1-to-1 is break even. 50-50 accuracy with 1.5 over long term is profitable. If you have a 1-to-1 profit loss ratio, but you have a 70% accuracy, you're profitable. If you have a 0.5 to 1 profit loss ratio, your accuracy is 66. I think that's break even, right? .5, 1 divided by 1.5. Yeah. 66% accuracy, you're break even. If you're below that, then you're not profitable. And the last thing that I wanted to touch on was about trading psychology. And I mentioned already about how sometimes you can do everything right, but the market will still go against you and you can still book a loss, even if you followed your strategy perfectly. And I think this also really helps your psychology in a certain way to understand this. If you can accept that there are certain probabilities and certain things out of your control. For example, if the market is cold and it's not giving you opportunities, that's outside of your strategy. You can't really control that. Or if stock fails more because it's colder, not really something you can control. As long as over the long term your strategy is profitable, that's what matters. As long as you execute on that strategy well, according to your rules, that's what matters. So if you try to trade intuitively, it can become a lot more emotionally pressuring, because if you think that you are the sole reason why you're losing money in the market, and you start losing money not understanding probabilities and risk reward, you go into a drawdown even though you are doing everything right, you might end up on a spiral. And then once you're on a spiral, it's kind of self-fulfilling prophecy, right? Once you're spiraling, then you may start doing certain actions that feed that bad behavior and cause you to hold in hope, cause you to take profits sooner, make you FOMO into trades, have, more fear of loss, more greed. But if you have a set of rules and you execute on your strategy perfectly, you kind of disassociate yourself from the losses and the wins. The profits and losses become a byproduct of the strategy, not a byproduct of yourself and your own decisions. The more rules that you can realistically put on your strategy to disassociate yourself from having to make decisions, the less emotionally involved you get when the trade doesn't work out. At least that's the way that I see it. That's why I like setting profit targets and stop losses before I enter the trade, before I get emotionally compromised. The trade doesn't work. If I follow everything in my strategy, I have good stock selection, the 5 pillars of stock selection that Ross always talks about, being up, for me, at least 30% on the day, having a catalyst that I can understand, being in the price range that I normally do well in, having high relative volume, and having a low float. If it has all of those things and it's breaking out, making new highs, and I execute on the setups well that I normally do well with, bull flags, ABC, CD patterns on 5-day breaks, continuation, breaking news. As long as I do all of those things and I do them well, even if the loss turns, or even if the trade turns into a loss and I stop out quickly, it's easy for me to just brush it off as it didn't work out this time. But I know statistically, 60 to 70% of the time, it does work out and it does make money. It didn't this time. You still have to ruminate on that. Why didn't it work out? Is there something that I missed? Was there information that I didn't have? But sometimes you really can just pin it on probabilities of the market and just accept it and, look to see what you can do better going forward rather than ruminate on the loss. And I think this is very important psychologically to understand. You can still enter drawdowns even performing perfectly. The part that you should become concerned, or the time that you should become concerned is if over a significant number of trades you're still not profitable. Maybe like 100 trades. If your profit loss ratio and your accuracy still aren't improving, or maybe the past 100 trades that you've had demonstrate significant risks, like your profit loss ratio isn't good, your accuracy isn't good, then it may be more cause for concern. But a few trades here and there, you can have 8 losses in a row for sure, 10 losses in a row, and do everything right. That's just the reality of the market. So it helps to disassociate yourself from those feelings and create rules to restrict you. Future Vael here, editing a little bit later in the day. There's just one additional point I wanted to add, in that we're all still going to feel some emotional attachment to each one of our individual trades to a certain degree, especially as beginner traders. We have so much to improve on that it's hard not to be attached to every single one of your trades. But the important thing is to focus on the process, not the outcome. Even experienced traders won't be able to get rid of the emotional part of trading, even if they've traded for many, many years. I know Ross Cameron talks about the emotional part of trading all the time. So completely disassociating yourself by creating rules, it helps. It helps to staunch the flow of emotions, but you can never completely get rid of it. I think that the goal for us as beginner traders should be to focus on long-term consistency. And to do that, we need to focus on the process and how we can improve ourselves as traders with each individual trade rather than focusing on whether or not they're a winner or a loser. As I've said, you can have winning trades that are completely terrible. You can have losing trades that you know, you did everything right, but the market just said no. So to a certain extent, our goal as traders is to get to a point where we can execute our strategy meticulously and flawlessly, as flawlessly as we can with the information that we're given. And past that, I mean, the market doesn't give you opportunities. If the market says no, even if you did everything right, you do have to adapt to the market to a certain extent and market sentiment. But as long as you have a back-tested strategy that is profitable in the market environment that you're in, and you know it is, and you execute on that strategy, you should be able to disassociate yourself from that loss to a certain extent, as long as the loss isn't too big. It's also important to have rules for the times of day that you're willing to trade so that you limit your exposure risk. You limit the probability that you're going to, to emotionally trade, and you increase the chances that you can execute your strategy perfectly without any external or internal factors that might prevent you from acting logically on the trade. That's why Ross tends to trade from 7 until market open in the brief period of time. That's why a lot of professional traders tend to trade in specific time frame windows where they're performing their best. They're not emotionally compromised. They don't have decision fatigue. They're not drained of energy because they've been looking at charts all day. And past a certain time, past 10:30 a.m. up until power hour, the market close after 3 until maybe like 4:30 or 5. A lot of the professional traders actually do tend to step away during that period of time because the volume decreases, and the volume is mostly comprised of algorithms and retail traders who are sticking around because they are emotionally frustrated by making losses earlier in the day and they want to make it back. So price after 10:30 tends to be a bit more illogical and not really all that predictable. And that's why I like pre-market trading as well, is because it's easier to manage that risk reward. It's easier for price to be more predictable because you're not having to deal with market orders, stop orders, circuit breaker halts, the increased volatility that comes with the significant amount of volume. Volume is generally good, but extra volume combined with the market orders and the stop orders can make stocks really whippy and be a lot harder to manage risk on. So that's why trading pre-market can be pretty beneficial for a retail trader trading small cap momentum. So what are some of the other rules that I have? A couple of my other rules include, max loss for the day. Once again, just preventing yourself from becoming emotionally compromised, setting a dollar amount or a percentage amount of your account that you feel that you normally become emotionally compromised and can't execute on your strategy and remain disassociated from the losses. At a certain point, whatever you feel that you start having intrusive thoughts, thinking, "Oh, I want to make this back. Maybe I should jump into this. Oh, is this going to go up?" You never want that to happen. So I have max loss. I have half loss back rule. If I reach my daily goal, but then I lose half of my profits back, then I stop for the day. Just things that you notice in your own trading that makes you become emotionally compromised, and setting rules to stop trading at those times. So we have trading in specific time frame window. We have max loss rules. We have half loss back rules. And I mentioned earlier, I have a maximum risk per trade. You never want to put yourself into a position where you could lose everything in a single trade. You want to survive till you thrive. You want to be in the market as long as possible to gain experience. You don't want to throw your whole career away in a single trade. You should set a max loss at a dollar amount that is comfortable for you. Or max loss per trade at a dollar amount that is comfortable for you. For me, it's 2%. Obviously, I don't want to lose 2% in every single trade. That's just if the trade really goes south and I end up losing like 50, 60 cents a share on it when I don't intend to, that's what my max loss is tailored to. Then, of course, you have the strategy itself, what you're willing to trade for stock selection and setup selection. What setups give you the most edge? For me, it's trading breakouts, trading breaking news, trading high day breaks, where the stock is doing something out of the ordinary. It's doing something extraordinary. It's breaking out of standard deviation, and where algorithms are going to start pulling away their orders on the ask and things start going parabolic. That's where I do the best, and where my upside part of risk reward tends to be the highest. My reward tends to be the highest, and my accuracy also goes up. Yeah, that's all I wanted to talk about today. I originally was going to talk about calculation of how to calculate profit or risk reward and profit loss ratio and accuracy. There's plenty of other videos that explain that. I just wanted to explain how I apply it in the middle of my trades, and how I calculate it based on float price, where the next level of half whole quarter dollar resistance is, and the best practices, or the practices that I found work for me as I'm in the middle of a trade, how I maintain my 1.5 to 2.0 profit loss ratio. And this is obviously very simplified for just a one entry, one exit strategy. It becomes a bit more complicated for like scaling and adjusting your stops in the middle of the trade to keep profits and maintain the profits. But I'll save that video for another time as I gain more experience in the markets, and when I have my risk reward and my strategies completely developed for when the market turns warm again. Yeah, that's it for me on this ranting video. I'll probably do some more videos like this in the future. If you like it, let me know in the comments below, like, subscribe, all that stuff. I'll be trading every day, 7 a.m. Eastern time, except for market holidays and weekends, as per usual. But until then, take care, stay green. I'll see you next time.